When it comes to gambling, a casino first comes to mind. But thanks to the pandemic, with everyone on lockdown, the Robinhood platform has taken over as the new favorite. Every day I see big wins and losses on social media by trading options. But beyond gambling, options can be used in so many ways, such as protecting your portfolio or generating constant income through various strategies. Even Warren Buffett takes advantage of options, but in a completely different fashion. Honestly speaking, for an average guy with no finance background, learning options can be extremely difficult, which is what I hope to solve with this new Start from Zero course. While you can learn about most things on Google, options trading can get a little more challenging. First, the definition itself looks confusing, so you go watch some videos and only end up even more confused. The key problem here is that we are trying to learn some complex terminologies without knowing why we need it in the first place. So for this course, I decided to take a different route, one that always works. If you take a step back and ask what we do in the stock market, we basically have opinions on a company, we put in some real money, hope to profit from our prediction. And the most common way we do it is by buying the stock. Stocks is generally easy to learn and understand. We buy the company and we can define how many shares we want. It can be 1, 10, 100, and then when we are happy with the profits or changed our mind, we can simply sell the shares back into the market. If our opinion is correct, this gives us a nice profit. Now, stocks are nice, but the problem is that if you have like a small account, you would have a really small return. For example, if I put $100 on Ford and it becomes 10% more, you basically made a small $10 gain. So for this to be something really nice, you probably have to put like 10,000, and then this will be worth 11,000 with the same 10% return. Now $1,000 is worth something. So if you have a small account and you want to increase your gain, maximize your gain, you can potentially do the same with options, because if I invest the same $100 on options, I can very well get this return if the stock goes up significantly. So if you have an opinion on a company, you can always express the same opinion using an options trade instead of a stock trade. What options can help you achieve is basically replicate a large stock position's returns. So if you see, the return on these two portfolio is pretty much the same, but the percentage is much higher for the risk you are taking. The only downside is that options are time bound. It has to happen in a specific time. Stocks are great and you can buy them and keep them for years and years. I have a 401k which is 100% into index funds, so I'm not completely against stocks. It's just that I have a small retail account. I am looking for a slightly better return on my capital. So the risk is basically that this 100 can easily be zero if your prediction did not work. Even the stock can have a net loss if the stock goes down. So this position could be worth 9,000 or $1,000 loss if the same thing happens. So as you can see, the percentage is amplified, but the dollar amount is actually less. So this is the reason options are considered risky, but you're not actually risking too much. You're only risking a small portion of what you're trading. Of course, if you wait for a few days or a few months, this will eventually become more than what it is right now, but your options trade is already gone. Warren Buffett started buying Coca-Cola in 1988. The original investment he made was 1.2 billion, but after so many years, this investment is now worth 20 billion. He is known for buying good companies and keeping it for a long time. And more than the return, he also collected 7 billion in dividends during this time. So I'm definitely not downplaying stocks, but I just want to give you the different kinds of opportunities you get by trading stocks and options. Options give you a much higher return by risking very small capital. It is considered risky, but has a much higher reward. The first time I looked at this, I was super confused. There was just a bunch of random numbers, and I had no idea what they meant. The very first thing you would learn is that there are two kinds of options. One is a call, and the other one is a put. While stock trading is as easy as buying and selling, options give you various possibilities. We can basically pick and choose from one of these values and buy and sell them like a regular stock. But before we get into the details of what this means, let me quickly show you a practical example from a real trade. During the March of 2020, when the pandemic started, Zoom Communications was one of the companies that really benefited from the lockdown trend. After seeing this on the headlines numerous times, I decided to make an options trade on Zoom. I knew that this company was experiencing a major surge in new customer signups. The momentum was on the positive side. While buying the stock would have given a nice 400% return, I had a small account and I went with an options trade instead. I got a call option for about 200 and I walked out with a very nice profit a week later. While this could have been a small win if I bought the stock, doing it with options really made it a big trade. Putting this in perspective, if we put in the same amount of capital on stock and options, the options trade was worth 3,200, and at a 50% return, the stock would have probably been around 400. As we can see, the options trade has given 20 times more return on our capital. In other words, if I have to get the same exact return with the stock, I would have probably had to invest around 2,000. This gives you an idea of how you can achieve more with less using options. The downside here is that this could have been easily zero if the stock did not go up during this time. But if the stock did go down, you would have probably lost a lot more by trading the stock instead of options. In this example, the stock position lost over $1,000, whereas the options position only lost $260. When buying call options, you can never lose more than you invest. Let's look at another trade, this time using put options. While Zoom had their best year, there were many other companies that had a tough time. One such industry was the cruise lines. I knew they were having a hard time because the CEOs and directors, everyone were selling their shares. As the price kept dropping from the peak, I tried to profit from the situation using a put option. Put options are profitable when the stock prices are significantly going down. I got into this trade for 160 and I got out a couple weeks later for 870. Let's take a look at how the stock did during this time. There appears to be a drop of 56% in the stock price, and it had actually fallen even more. I still got out with a nice profit. This is probably close to a 500% return, and it is not something you can easily recreate with the stock. There is no direct way to profit from regular stock trading when the stock goes down. There is something called short selling, but usually this is only done by professionals. As a small investor, the easiest way to benefit from a drop in price is by using put options. Once again, if the stock did not drop, the maximum we would have lost here is the $160 that we paid for the put option. And as you can see, you don't have to catch the extreme top to the extreme bottom. No one can really time the market. But if you have a short-term opinion, a strong opinion, you can always start somewhere and try to profit with a quick options trade. And of course, these kind of large moves are very rare in the market. If you see the same stock since that crash, it had basically went sideways within a range. It probably traded around this $20 mark throughout the last 1 year. Which brings me to my next example, a trade that I do very often. Using options, you can also profit from a stock that is moving sideways. And that is achieved by normally selling instead of buying the option. For this sideways strategy, surprisingly I did this on Tesla, which is the last stock on the planet you can apply such a strategy. But there was a main event happening around the month of December on the 18th. I knew that leading up to the event, Tesla might not swing too much until that particular day. I just stayed in the trade for a day and got out with a quick $200 profit. Here is a recording from that week where I actually made the trade. As you can see, Tesla started and ended around the same price, helping me get out with a small win. And there are multiple strategies you can apply when you have such an opinion. I went with this strategy called a butterfly spread, which is a low risk, low reward strategy, but you can also do this using an iron condor or a strangle straddle. These are slightly advanced and we will surely get to them at the end of this course. But for now, I just wanted to give you an idea that you can use options to really trade in any markets. The amount of flexibility that you get is just unbelievable. I hope you got a quick idea on what is possible with options. I wanted you to understand why we need it before actually diving into the concepts behind how options work. In the next video, we will dive into greater detail on how a call option works and how to make a trade with it.